Somebody sounds upset.
Yeah, they've got a voice.
Ah, how old is the little one?
6 weeks.
Oh, wow. Ah,
Tiny
been a
little thing.
while. Been a while since I've had a 6 week old. Mm.
It's fair. Okay, well, I will get started. You guys know we are the Bookkeeper Blueprint. Um, and we started this because Megan and I both run a bookkeeping business. Um, all of those things, and we talk about things that we do and whatever is working. Some things work some seasons, some things don't work other seasons. My name is Sherry, for those of you that don't know me, and I do have a master's in accounting and have spent several years working in CPA firms, pursuing my CPA license, and decided to do the mom thing and gave up pursuing the CPA license. And went about just serving and solving problems. And that has been a lot of fun. So today, that is relevant because we are talking about really mastering the basics of bookkeeping. A lot of you guys, this is a new field for you. You don't come from an accounting background. Some of you, you're interested in it because you do personal finances, your own personal finances, your own budget. You like doing budgety things. You like doing repetitive task things like that. And this is a great way to do some of those things. I know I've talked to some of you, and coding transactions is just about as good as playing Candy Crush. So that is totally fair. But I wanted to spend some time today just talking about, um, what is the second language that you're trying to learn? So if bookkeeping has felt like a second language, we're going to decode that. Today, we're going to kind of dive into it. You don't need an accounting degree to run a bookkeeping business, but you do need the basics. And that's what we're going to tackle in today's podcast episode. Um, and many beginners really get stuck at this stage. Some, I will get on a call with them. They're 6, 7 years in, and they're really arguably still stuck at this stage. And they're unable to solve the problem that they have because they don't know the full picture of how accounting works. So, learning these basics, and we're going to be high level today. We go more in depth inside of the Bookkeeper Blueprint course and program if you're looking to go deeper. But understanding how this works will allow you to solve problems quicker than doing it the hard way, if that makes sense. Um, these core concepts are going to help you understand how to use QuickBooks more efficiently, how QuickBooks is designed to work, even though they make it designed for like the business owner who doesn't know what they're doing. It will help you understand how it's just designed. It will also help you understand how others third-party systems work and how those systems work with QuickBooks and how those integrations work. You'll feel more confident talking to clients because you're going to understand if they throw out a word to you or if they have a problem. You're going to start to understand the picture of where their problem is in the bigger concept of accounting. Okay. So many of you have heard the term double entry bookkeeping. So every transaction inside in a bookkeeping process, in the theory of bookkeeping in accounting, has two sides. Something comes in, something goes out, right? That's double entry accounting at the basic. Some examples of this are a client pays you $500. You're going to increase income, which increases the bank account, right? So it's two sides. So increase to income, increase in the bank account. If you buy a printer, you increase expenses, and you're going to decrease the bank account. Okay, so it's not always increase, decrease, right? So we increased income and increased bank account. In the example of the expense, we increased expenses and we decreased the bank account. Okay. Okay, so that is coming from the larger accounting equation. Assets equals liabilities plus owner's equity. That is the balance sheet. If you've read through the balance sheet, you're going to see assets at the top. That's your bank account. You're going to see and fixed assets and things like that. But any type of asset that you have, accounts receivable is an asset. Then you're going to have liabilities. So this is your accounts payables, your credit cards, your loans, your line of credits, your due to, due froms to an, you owe another company. All of those things are liabilities. Tips liabilities, payroll liabilities, right? That's all in that next step. And then you have owner's equity. This is any contributions or distributions. This is retained earnings. Some of you guys will let owner's equity or opening balance equity sit there. We don't recommend keeping that account, but QuickBooks will auto-generate it. So that you'll find that down there if you're looking for it to fix it and things like that. That's all equity. Okay. What happens on the P&L informs that equation. Okay. So debit is going to be on the left side. So if you were thinking T accounts, and man, I wish I had a my remarkable or whiteboard still. But if you think about a T account, debits are always going to be on the left side and credits are going to be on the right side. If you run a report in QuickBooks, there is a setting. If you go into like customize the report, like if you're looking at a transaction report, you can have it show debits and credits. You're going to always see debits on the left side. You're going to always see credits on the right side. Okay. If you run a trial balance report, you're going to see the same thing. If you run a general ledger, you're going to see the same thing. Debits will always be on the left side. Credits are on the right. However, debit does not always mean decrease, and credit doesn't always mean increase. It will depend on the type of account. Okay. So, and I'll get into that, but don't overthink these words. Don't overthink debits and credits. If a client is talking in debits and credits, just make notes and you can look it up. We have a free download if you're looking for like a cheat sheet on what's a debit, what's a credit, what increases the account, what decreases it. We have a cheat sheet that shows you that on our website. I want your goal for me, my goal for you is to focus on what's happening in the business and what's happening with the transaction. What story are these transactions telling you? Right? So if my client purchased a let's call it a $5,000 printer. They bought a big, massive printer. Maybe it's a screen printer and they're printing t-shirts. And I asked them about it and they're like, yeah, here's the, invoice for it. Here's all the detail behind it. And be like, oh, okay. It's one big, large asset that I want to put on the books. Wait, is that an upgrade? Let's say their comment actually said, we bought this, our other one died. Well, now I know that one transaction is telling me I also need to remove a fixed asset from the books. They may be disposed of it. They maybe sold it because it could be fixed. They might have recycled it. So what happened to the other asset? And so I want you to focus on what's happening, because once you understand what's happening, everything else can take care of itself. We can get you there, but you need to know the story behind the transactions. Okay. So every transaction that is going to help you tell that story falls into one of 5 buckets. It might fall into an asset account, and that's what the business owns. So their checking account, their accounts receivable, their fixed assets like the screen printer I was just talking about. So cash, equipment, those are all assets That is what the business owns. Liabilities are what the business owes. So that's your credit cards, unpaid bills, your accounts payable, any loans, anything that is owed to another person, formally or informally. It should technically all be formally, but I've seen you guys come to me with, hey, we have a kind of informal loan on the books. Now, with that said, there is IRS guidance on how to get a loan from a friend and what you need to make it IRS compliant, what that agreement needs to look like. Equity. So we have assets, we have liabilities. The third bucket that a transaction can fall into is equity. And this is the owner's share of the business. So this could be owner's investment, owner's draws, distributions, the state of equity. If you can start diving into equity, you might have more accounts than just like owner's equity. But it's ultimately equity is going to be comprised of the owner's share of the business. Income. This is the money the business earns. So this is going to be found on your profit and loss statement or income statement. Money the business earns. This is sales, services. You can break that down further into maybe they have a contra account discounts or something like that. But any sales, any revenue generating activity, any money coming in, commissions, affiliate earnings, that's all income. Expenses, you're going to see underneath that income line on the profit and loss statement. That's the cost of running the business. So the IRS defines a tax deductible expense as anything incurred in the course of business in order to generate revenue. So that could be staff, payroll expenses, supplies to create the goods, to create that widget, right? So rent your software, meals to keep the business running, right? And if you can understand these 5 buckets, you can learn to track anything. And that's where I want you to understand what is this transaction doing? What was the intent behind it? Now, when I said earlier, hey, the client bought a screen printer, but also they're letting me know that the other one kicked the bucket, that's not all one transaction. That's different transactions. So sometimes we'll ask a question and a business owner will word vomit on us and give us everything. And it starts to be trying to solve 5 to 10 transactions in one transaction. We really need to separate out which transaction is what. Okay. It all helps us tell the story. So those are helpful, but sometimes you need to step back one transaction at a time. And if you ever talk to me and you have that situation, I'll walk you through each transaction. And I will know that there's more than one transaction involved as you start telling me the story, if there is. Okay, let's say your client sells a product and gets paid $100. Okay, so this is transaction flow. So the client sells a product and gets paid. So we actually collected the money. We're going to increase income by $100, which will increase the bank account by $100. So that's double entry accounting. And every transaction has a give and take. In science, we say everything that must go up must come down. Equal and opposite reactions. That applies here. So everything has a give and a take. Okay, as far as the chart of accounts, so what are the chart of accounts? In plain language, if a client said, hey, what do you mean by a chart of accounts? This is just a list of all the accounts or categories a business uses to track money. And you can think of it as like a bookkeeping menu. This is the menu that we can select from in order to keep the transactions organized. Okay. So I'm thinking of like think of like your Google Drive, and if you have folders, that's your menu. I can put stuff here or here or here, and I'm limited to this menu. Okay. Um, different businesses need different charts. So a dog groomer versus a electrician are going to have different accounts on their chart of accounts. Okay, they're going to have a different table of contents. They're going to have a different menu to select from. Different type of business structures will have different charts. Overall, the chart will still be basically the same. There's going to be some things a business needs that another one doesn't. So how does bookkeeping happen in software? So I just gave you like the paper version of how this is all working. The good news is you're not going to be doing any math by hand in a software like we just went through. You're not going to be doing T accounts. You're not going to be using green ledgers. But bookkeeping software does most of the heavy lifting, which is why I think it's more important for you to at least know what the story of the business is. What is the story behind the transaction? And then what's the bigger story of how this is going to flow into the financials? And if you have found yourself feeling stuck on reading the story out of the financials, inside the Bookkeeper Blueprint, I specifically speak to how to read and understand financials from that perspective. So if we do a transaction and then we go look at the financials, do the financials reflect the story that we were trying to tell? And that is how you first review, did you do it right? Did the software do it right for you? Did I do what I intended to do? And we check that by reading the financials. So if you need help with that, let me know. And there is more help for you in that inside the Bookkeeper Blueprint, and I can always help you with that in a one-to-one private coaching call. Okay. So your goal is to categorize things in the proper accounts and make sure that those accounts, those categories, are in the right bucket. For instance, if we buy maybe a $200 printer, we don't want to put it as a fixed asset. It's under the IRS guidance. We're just going to expense it out. When I select the account, I wouldn't expect to see office expenses under fixed assets unless there's two maybe categories. Maybe we're saying office equipment as fixed assets, but then we have office supplies or office expenses as an expense on the P&L. I want to make sure I select the office expenses that's going to show up on the P&L, not the office equipment that might show up on the asset account. So I want to make sure I have the right categories selected. I want to make sure I have it organized and that it's going where I intend it to go. You're also going to reconcile to make sure everything matches. I was just helping someone on a coaching call, and through some things QuickBooks did with payroll and just how things were categorized, how things didn't really get matched, there were duplicates. And so when we opened the reconciliation, there was additional transactions that were just left hanging out there. Beyond the ones, like there were some of them that were legitimately supposed to be on there because they cleared in the following month, say September. But there were some transactions in August that looked funky to me, and I opened them and discovered that they were indeed duplicates, and that's why they weren't clearing. That is your goal, is to make sure there's no duplicates, to make sure everything reconciles, to make sure everything stays clean, and ultimately tells the story that we're trying to tell. Okay, so if she had looked at the financials, she would have seen an overstatement, which means duplication, too much in office expenses outside of normal. And I just say office expenses. I am making up that particular category there. The software won't make sense unless you understand the basics we've covered today. But now you have a framework to get there. Okay. I wanted to cover before I open the floor to questions. And if you have questions, feel free to post those. I haven't checked them out yet, so you guys might be posting them already. Oh, good question. I will answer. Actually, let me pause and answer that. Okay. How does duplicate transactions get added to the books? Multiple ways. You can have an integration bringing in a transaction and a bank feed bringing in a transaction, but you don't match them. In this case, there was a bank deposit that selected the invoice and the payment, and she added the receive payment. And then the receive payment wasn't actually included in the deposit. It wasn't selected in the deposit. And so it was duplicated. It was just an error in workflow. And that's where it's important to really understand what QuickBooks is doing, what your integrations, your third-party systems are doing, and then making sure you have a good workflow. But ultimately, reconciliations is a good gut check to make sure that we haven't messed up that workflow. So that's what happened in her instance. There's a lot of ways to get duplicate transactions. Sometimes what the most basic way that will get everyone is if you're using the bank feed exclusively and you're not putting the transactions in. So ideally, everything on the bank feed should be matched to a transaction. That is originally how QuickBooks was designed. That is proper accounting. Most of you guys are doing month-end accounting, so you're not entering the expense and the invoice and the sales receipt to match to the transaction. So the bank feed will break. There'll be a bank glitch. It will break. It will reconnect automatically. You coded it yesterday. You get back in to code it. You see 5 transactions. You code them. What you don't know is the last one you coded yesterday and the first one you coded today are the same transaction. So when you go to reconcile, you're going to have a transaction on 9/24 that says office supplies $250, Office Max, pick an office store, 250. And then you're going to have a transaction that comes through September 25th saying Office Max, $250. But when you log into the bank, you're like, that's weird. You really went, that's the same exact amount. Did you really go buy the same? Like, what happened? That is going to look funky. When you log into the bank, there's actually only one transaction. And so it came through duplicate and the date is different. So it just makes it look like it's 2 different transactions. Sometimes they really are. So always verify with the bank. But in this case, you logged into the bank. You only see one transaction. You waited a couple of days. You still only see one transaction. One of those you should delete. So that's just beyond that. That's just a software glitch. And it's our job to catch those. So it could be bookkeeper error. It could be the client entering something, us not knowing how they're entering it, it not matching correctly. For instance, them not selecting undeposited funds when they enter receive payments and doing that process. And so, then it creates duplicates. So yeah, hopefully that helps. Okay. So in that, I covered some mistakes beginners make, but to dive in a little further, you're going to start trying to memorize debits and credits without context. If you want to learn how debits and credits work, we have created a specific training inside the Bookkeeper Blueprint to help you learn those. So I give you shortcuts, I give you analogies, and I give you like an actual training on how to learn them using mnemonics and just study tools for you to learn those and not have to like Google debit increases. Like, how do I increase this account? How do I, thankfully you guys aren't doing a lot of journal entries by nature in QuickBooks, but when you do need to do a journal entry using our cheat sheet, going through the course and learning the debits and credits, how they actually work within each other, you're going to connect those dots fairly quickly. If you really need help with a journal entry, I'm happy. I do a lot of journal entries for you guys. If you need help with a journal entry, feel free to book a call with me and I can help you. I have days and Saturdays available for those. But the best way to learn them is to actually learn them, and you can do so inside the Bookkeeper Blueprint. Don't get overwhelmed with terminology. Some of you guys want so badly to learn the terminology. And it's a good thing to do. You should, over time, learn the terminology. And if you want help doing that, I do actually have I have all the accounting terminology inside the Bookkeeper Blueprint, and I actually have a download for you there. If you wanted to turn it into flashcards, something like that, it's all right there for you. That's going to help when you have a client who wants to speak in that terminology. So they're throwing terminology out at you. You can find this with CEOs who have a little bit of accounting training, not really QuickBooks, and they're saying, hey, this is what I expect, and they're using debits and credits. So just to keep up with them, we never want to use terminology to make ourselves look like we know more to a client who really just wants to make sure it's done right. Terminology will not help you win the bid, per se. Okay. The third mistake I see beginner bookkeepers make is thinking that QuickBooks will just take care of it for you, and then it will teach you how to do bookkeeping. I get on a lot of calls where a bookkeeper has just dove in. They've gone straight to the bank feed. They've started coding the bank feed, and they have made a bigger mess of the financials, of the bookkeeping, of the software in general, than if they had taken a step back to understand what has happened in the software before they started. Okay, so if ever you have a doubt, or if you're not sure, or if you just want to make sure you're not going to have to go back and undo something, ask, what happened to the money? Where did it go? Where did it come from? So what happened to the money? Where did it go? That can also be who did it go to, right? So it's the same question. And where did it come from? That is going to help you understand both sides of that double entry account. Those three questions. So when in doubt, ask what happened to the money? Where did it go? Who did it go to? Is the alternative to number two. And then where did it come from is number three. Okay. All of that, we go into way more detail inside the Bookkeeper Blueprint. If you just want to talk it through, if you're like, hey, this is where I'm at, this is what I know of bookkeeping, this is what I'm struggling with, feel free to book a call with me or Megan, and we can help get you the right resources. We've got some other like smaller trainings and things. If that would help you, we can get you access to that too. Right. I'm going to jump over to questions, but if you have any questions on what we talked about today, and then if you are inside of the Bookkeeper Blueprint, I know you guys join us here as well. I will invite you to unmute if you have a question. Okay. I have a question. I have questions about transitioning a sole prop to an S corp for retro election. I purchased a call. Okay, so their CPA can help with that. As far as QuickBooks goes, I can help with that. Bonnie can help. Kristen can help. Those three are going to be the best three, but so that would be us helping you in QuickBooks Online. But as far as if you have questions for the business owner, or if the business owner has questions about how to file that, that would be a question for their CPA. Some of us know how to, but it's not what we coach on. So yeah, I can help with that, Cameron. But Bonnie, Kristen, there's others too. So anyone who has advanced accounting on their list can help. Okay, yeah. So yeah, we'll just go back and do that. Is there any specific question that you have? And I mean, I can talk to you.
Yeah,
Give you a
I
call.
definitely still want to like have a session just so to sit down, but I'll definitely have some questions. So, they've been operating at, it's a situation I asked about before, but now it's actually happening and I need to handle it. So they were operating as a sole prop ever since, and I've been doing the bookkeeping ever since January of this year. Now they've put in the election, they got the approved election. Now they're an S corp. So this person's been taking out draws and operating as a sole prop, and now that needs to be fixed because they got a retro election and it's effective as of January 1st of this year. So I have to clean up like the equity. This person has bad books from last year. I wasn't engaged to do that. So I kept telling them, the balance sheet's got to be clean, especially when you get S Corp, we're going to have to worry about it. But now we're here. The person is not on accrual there, but they do invoicing through QuickBooks. So there has been several receivables from last year that had broken workflow. Undeposited funds are messy. um, there's other like liability stuff on the books that's needs to be cleaned up. So I just need to know like what to do to ensure that he's good to go. Um, transition wise, because I know you can't do owner's draw anymore. It's got to be distributions, got to be in a certain way. Person's got to be on payroll now. So yeah, it's just like all of those questions, and I just want to like get like a good checklist of things I need to advise and help the client with. That's within my scope, and just make sure that they're good on QuickBooks moving forward.
Yeah, so in the meantime, while you get that call scheduled, and then I don't know how, when your availability is for that, but in the meantime, it's really just doing a good cleanup for 2025. So addressing, making sure all the payments are applied to proper invoices, not just guessing. Like not just applying to the last invoice until like it weeds itself out, like making sure we know why does this payment go to this invoice? Why does this payment go to this bill? I think they're just using invoices, but liabilities, um, reconciling those. Um, doing the proper cleanup in 2025 will help weed out what was wrong in 2024 to some degree.
Okay. And like there's like loans and liabilities and stuff that's been carrying over that are a mess, right? And it's affecting me now, right? And even though like it was last year, is there like a way? Is it something that needs to be handled now? Like it's got to be sent to like an equity account now. Like I don't, but I guess that's more we can
No,
talk
we
about.
first need to reconcile what is the liability? Like what is the amount? How do we reconcile it to even reconcile September of 2025? How would we reconcile it? So what statements would we get?
It's
What data are we going to get to reconcile this?
yeah. It says like it's a loan to others, so it wasn't right.
Oh,
It just wasn't right. It's like a
you would
negative
ask the
balance.
client, what is the outstanding balance? What do you owe
Mhm.
this person?
Okay.
Right. And if they're like, oh, I paid it off in 2022, then the balance as of December 31st, 2024 is zero. And then we can do a journal entry. But first, you can take notes. Just go through the balance sheet and take notes. What was the balance? How do I determine that balance? Is there a statement? Is there a resource? But it might just be asking the client,
Hmm.
you know.
And like retained earnings, is that zero? Starts at zero for S corp, or not really?
Yes and no. You're gonna want to work with his CPA to
Hmm.
determine that. But you're probably going to be hitting prior, like an adjustments account and not retained earnings when you do your journal entries because his retained earnings is his retained earnings. Um, so I would first worry about getting the books cleaned up. So, but I wouldn't be making journal entries to retained earnings.
Okay. But it would need to have a start point, right? Because this is the first year of S corp, and I know retained earnings isn't a thing for any other, for sole prop. So I'm just wondering like what that would look like. But I guess more on the call. I guess I get more information.
Well, retained earnings exists for every business. But for tax purposes, we don't report a balance sheet for a sole prop,
Hmm.
but they still have retained earnings.
Okay.
Like for an LLC or like single member LLC it's not an S corp or a sole prop, the balance sheet is still in play from an
Mm.
accounting standpoint. Right. So an S corp still has distributions and draws. Those are interchangeable words. A lot of S corps you'll see will do a year-end payroll and pay those payroll taxes at that time. They can do it quarterly, they can do it monthly, and that could be based on the distributions that they've taken this year, right? So yeah, I can help you walk through like what to do now. But first I would look at, let's still reconcile it as if we're reconciling any cleanup that we would have reconciled. But I would encourage you to create an equity account called adjustments. And you'll
Hmm.
see this when you go to create a new account. You can put like prior year adjustments or accumulated adjustments, and you're going to see the account type called accumulated adjustments.
Hmm.
And so I would use that account for any journal entries. I wouldn't hit retained earnings for now.
Okay.
As
And that would
you'll
be like the prior year stuff, right? So the stuff that I'm not engaged to do, but it needs to be cleaned anyway.
I mean, I guess this is just my opinion, but bookkeeping should be right from day one. So I'm not going to sloppily get to my beginning balances based on a guess and then try to just clean it up in 2025. So when you say not engaged to do, like you're also the one who signed up to do it. So yes, there should be like good, you should know what you're doing for scope, but that doesn't excuse like doing something incorrectly to be able to do 2025 to only have to like do another adjustment in 2025 to make it work. We need to properly, if you're engaged to do all of 2025, we then need to figure out what that beginning balance is correctly. That is on us too. Does that make sense? Like we can't just guess at what that beginning balance was.
Yeah. So like I did a diagnostic review and they didn't pay for the cleanup. But the person already filed taxes, but they also didn't have a balance sheet. It wasn't a filed balance sheet because it was a sole prop. So I guess that's why it wasn't that big of a concern to them. But now, now it needs
Right,
to be
but
right. That's where.
right, but it's still on you to get it right, to
Hmm.
get the beginning balances right.
Right.
I'm taking issue with, well, I'm not engaged in it, so I'm not going to do it. But you are responsible for doing the beginning balances, so you are going to have a conversation with the client. Does
Hmm.
this loan still exist? You can't just assume because it's a personal loan that it's zero.
Hmm.
You can't just assume everything goes to zero on the balance sheet because they didn't do it right.
Right.
Right. So we still have to look at each of those liabilities and say, what should this have been? Because it might still be open. Maybe they really haven't paid it off, or they're like, hey, I don't know how much I paid it off. I'm gonna go figure that out for you.
Hmm.
So we're not just gonna like even them, like if they can go figure out what the balance is, you can put the task back on them to go
Hmm.
determine what that balance should have been. So I'm not telling you to go do the work yourself of figuring out what that balance is, but there needs to be an accurate figuring out of what that should have been.
Hmm. Okay.
And then you're going to hit that accumulated adjustments account to flow it through.
Okay. So for the call, like, is there anything that I should gather for you to make it more, just so you have everything that you need to answer, like anything I should bring?
As much as you can figure out about the financials before you get on that call. I mean, schedule it for when you can schedule it. In the meantime, as much of that cleanup as you can do as far as getting answers, and then I can help clean it the rest of it. I can help you get it the rest of the way there. But it would be helpful for me to know, is this open? Is it closed?
Okay.
And then I can give you guidance on like, we'll ask this question to the client to see, is that really correct? And your client already knows that they messed up, and you know, they're looking, most do, right? Like they know it's not right, and that their goal is to get it right by paying you. And so we're just gonna lean on that.
Now, the person's not on accrual, but they have AR. Like that wouldn't be on the balance sheet, right? If they're cash basis.
When you run, by default, when you run the balance sheet in cash, it will remove accounts receivable from it. But absolutely, if they're using invoicing in QuickBooks, they have accounts receivable, regardless if they're cash or accrual. But when you run those financials, it will do the adjustment to remove that accounts receivable.
And
from the financials.
that AR doesn't go on the Schedule L on cash basis.
No, but you're going to run the financials in cash in order to do that. But your client, as a result of using invoices through QuickBooks, every cash business has an accounts receivable. Right? It's just, but because it's not earned, it's not taxable.
Right.
It is hoped for, it's just incurred.
Right.
So yeah, every cash-based business has accounts receivable. It is not formally on their balance sheet as cash.
Now, how often do like companies like do bad debt, like for really old receivables? Is there like a cadence, or is there like very
It's
dependent
annual.
on the annual?
Yeah. But you would look at their internal processes, which this client doesn't have them clearly, but you know, you should be reviewing accounts receivable every month and be seeking to collect any old debt. And then there should be a threshold. At this point, what is that AR policy? How hard are we going to try to collect this? And then if it's XYZ over, we're going to go ahead and determine if it's XYZ number of days over. At what point have we deemed this uncollectible? And sometimes it's uncollectible from like 30 days out. The client went bankrupt. They're not paying you. They've already told you that. And so then your choice is to write it off or send it to collections, I guess, if you have that relationship established, or a service that does that for you. Does that make
Yeah, I need
sense?
to look up on that. Yeah, to see.
But ultimately it's an annual thing if they're going to claim it on taxes. So at least by year end, we're going to be looking at January, February, March at minimum, right? Are those still collectible? Or do we still think we're going to get paid on them? So yeah, every year for any business, even cash, we should be evaluating that. So but I do want you to hear that even cash, we are evaluating bad debt for. I think sometimes bookkeepers hear cash and they're just like, oh, I don't really care about the balance sheet, but you should 100% either way, because there are tax implications, regardless if they're cash or accrual for that balance sheet.
But if they're cash, you wouldn't. There's nothing to write off, though, right? It's just to remove the receivable because you haven't realized revenue.
Yeah, there's a reason I tell you guys to review your client's tax returns because you'll learn a lot. You can write bad debt off in
Really?
cash, depending on the debt and all of those things. But even like the liabilities being correct or incorrect matters because interest is still expensable. It's still tax deductible. So yeah, either way, we still care about the balance sheet, cash or accrual. We still care about it in full. And then as far as the tax return goes, we are just running a cash basis report. But to clean up accounts receivable, we should be cleaning that up just like any client. Cash or accrual is just really at the end of the day is really just a tax function. Our bookkeeping, if we were doing bookkeeping to an accounting degree, oh, just a second. But from an accounting standpoint, earlier I said, ideally we are matching every expense on the bank feed to what's in QuickBooks. That means we should always have that means we should be getting the bill, entering it, and when it's paid, matching. There is a formal process to accounting that in the month-end process we were skipping. And you have the right to skip it. You can skip that. You're just doing month-end, which is why bookkeepers don't charge a lot, or a lot of bookkeepers don't charge a lot. If we were doing it to its most excellent level, all you're doing is toggling between cash and accrual. But the accounting is done. If they were to select accrual tomorrow, we have accrual books for tomorrow. We just need to do an adjustment for that cutoff for when they filed taxes to accrual. Like what was captured when they filed versus what wasn't. But theoretically, you should be able to toggle the books and have accrual just immediately. Many of you don't because you're not doing that level of bookkeeping for your clients. Does that make sense, Cameron?
And
you know the accounting, you know the accrual. Yeah, because you have an accounting background, right?
College. I didn't know CPA or anything like that, but yeah, I took intro, took cost accounting.
Okay, so you might not have that level of just experience with the accounting in play.
Yeah.
And that's okay. But ideally, what you learn in text should be in practice for cash or accrual. We should be doing that formal accounting that we can just switch back and forth. So the only reason I went to that route, Cameron, was what I heard from you in the underlying, the way you were using the word choices that you were making. Was this, well, they're cash, so I can take this shortcut. Or they didn't pay me for 2024, so I can take this shortcut to get the financials. And I'm just arguing against the perception that there's a shortcut in the financials. You are basically going to take a shortcut because you have to, you're limited in what you can do. But I'm mainly trying to and this is for everyone, hammer in what should be versus this do the bare minimum, right? It's
yeah, I don't know. Sorry about that. I don't know why that came up.
Oh no, you're good. There's a chat. I was like, who's giving you notes? Good summary. But yeah. So hopefully that's helpful and not not to discourage or like be overwhelming. I just
Yeah, no, I mean,
want
this is,
to help
I
give
need
you
to,
the whole picture.
I need to learn. I'm glad I'm in this situation. I knew it was going to happen eventually. I just, I just got an email saying like we're now S corp, and then I didn't answer because I'm like, oh, I got to figure out, but
Well,
yeah, I
and do
just
you
want to
know
make
how
sure
much the
I'm doing it the
CPA
right
is
way.
doing?
Oh well, the CPA just filed a form. That's how they did this a couple of months ago for, I
Yeah,
guess,
some CPAs will still make the adjustments anyway. So, like anytime
I
you don't know,
didn't
you
get
can
some
lean
stuff.
on the CPA to make those. Um, does that make sense? Like, so like retained earnings, the reason I'm not harping on you right now to like exactly know what that balance is or to make it zero is ultimately we'll let the CPA finalize that number for them
Hmm.
at year end and we'll make the adjustment. Or we can have the conversation based on where the financials are at. But I want to put your time more on what should be and what should have been versus like then trying to adjust retained earnings to zero.
Yeah,
Because that's a distraction to getting the full picture.
yeah, and I also just like want to have an SOP just so this will happen again, right? I just want to like when this happens, this is what I need to do. This is what I got to look for, so on and so forth, and then I can advise the client much better, and I can do what I need to do. That's kind of more what I'm trying to accomplish.
Yeah. So what are your future plans? And we actually, never mind. We have 3 minutes. I was going to ask what your future plans are around hiring.
Around hiring for a bookkeeper.
Yeah, are you planning on ever hiring?
Not now, no. I mean, not until I get good acquisition. Definitely not something I'm looking at now.
Gotcha. Um, so I mean, as far as your process goes, it'll be a little bit in flux. Then, and did you say that they're going from an LLC to an S corp, or they went from sole prop to S corp?
Single member LLC to S corp.
Okay, yeah. So they'll take some of that. They'll take their true retained earnings balance forward. In a sole prop to S corp, it becomes a new EIN. Like it becomes a whole new business.
Right. Yes.
Yeah.
Right.
So
Yeah.
the
To get
balance
here
sheet
in
for an
LLC.
LLC
Hmm.
carries forward into S corp.
Hmm.
It
Yeah.
doesn't
It's just
start
the fact that it was a mess last year.
right, but
That's what.
that's where I wanted to like just point out like we have to
Mhm.
fix it
Yes.
and fix the retained earnings balance to what it should have been
Hmm.
and determine what it should have been, and then go forward. If it were a sole prop, it's a whole new business, so we'd probably be in a new QuickBooks file. But like we're not zeroing out the balance sheet to start over because that retained earnings balance from day one of the business, they have retained earnings and it should always be correct. It should be the accurate accumulation of net income, distributions, that equity. It should be that balance. We shouldn't have these adjustments hitting retained earnings.
Now,
So
it's also important that the current QuickBooks match the tax return, even though there wasn't a Schedule L. So, like the Schedule C should match the 12. Okay, so I think that's another problem.
yeah.
Okay.
So I mean, and you might have to go back to the client and say, hey, this is and that might be a conversation with the CPA. How much
Mm-hmm.
does the CPA really care? But from a accounting standpoint, we care.
Mm-hmm.
From day one, the bookkeeping should be done correctly.
Mm-hmm. Yeah, this is the type of stuff I wanna add. Okay.
Yeah. But theoretically, understanding how the financials work, when we determine what those liabilities should have been, where did those payments, like, we're going to kind of wonder, how did that, let's say I got a $30,000 loan. I paid that personal person back, my friend back. But it was considered a distribution, right? Which flowed through retained earnings. So now, but it didn't get counted against the loan when I took out the distributions. It wasn't paid off. So where was it? And that's going to inform how to fix it.
Mm-hmm.
So you say you paid it off. When did you pay it off? How? And go look at the transaction. And you're basically going to fix that transaction. Not really. But if it went through an expense, it flowed through retained earnings, which is why people are like, just hit retained earnings. But like, where did it go? Confirm that it was actually in retained earnings. And that's going to inform how you fix it.
And that would happen January 1st, 2025, right? Because I don't know if I
Yeah,
want
you're basically going to close the books December 31st.
Yeah.
After you close the books, depending on where you need that retained earnings. Because remember, anything you hit on December 31st, 2024 will flow through retained earnings through.
Mm-hmm.
So you might need it to be posted 12/31/2024. That's where it you have to know what it's doing when you roll it forward to 1/1/2025, how it impacts that.
Yeah, so it needs to match to the tax return, and okay, all right.
Well, the liability isn't going to impact your tax return. That's your income and expenses. That's different conversation than the liabilities.
Yeah, no, I mean the retained earnings, because I know the tax return, the QuickBooks file didn't match because they didn't use that.
Okay,
So
how
that's
long
why
have they been in
retained
business?
earnings, 4 years.
Okay, so I mean, 4 years, you could theoretically get the tax returns and correct it all, like with a few journal entries. But yeah, we can talk more.
Yeah, you have availability today?
I do not today. My day is
Okay.
booked today.
Okay.
And I don't have any Saturday spots open anymore. So it might be next week, Monday, Tuesday.
Okay.
If you're getting along with me. There might be another coach that does have availability.
Yeah, I mean,
Okay,
you already know now, so I kind of want to work with you, but okay.
Either way. Okay. Well, I will see you guys next week.
All right, thank you.